This is the week of July the 1st, 2013. This is Michael Can speaking, and these are our market comments. First, we hope that everybody had an enjoyable Canada Day weekend. Back to business. North American stock markets have returned to more volatile trading since mid-May. The S&P 500 posted a decline of 1.3% in June and a quarterly gain of 2.9%. But the fall in the Canadian dollar boosted those returns in Canadian dollar terms to 0% in June and a plus 6.2% for the quarter. The TSX was lower by 4.1% in June, while the quarter was a disappointing loss of 4.9%, as gold traded to new multi-year lows and oil stocks moved lower in spite of oil trading relatively unchanged during the quarter. So why are markets agitated now? The good news is that economic figures in North America continue to suggest that the economy is improving in the United States. Housing, jobs, and other activity figures are improving. The bad news is that means the Fed is likely to discontinue stimulating the economy and interest rates will likely rebound higher. How much higher is anybody's guess, but consider this. 10-year yields on U.S. Treasuries bounced from 1.6% to 2.6% in 9 weeks, a 62% increase, and 30-year U.S. mortgage rates jumped from 3.4% to 4.46% from the end of May to the end of June, a 30% rise in 4.5 weeks. Needless to say, bond investors suffered losses in June. Some participants seemed surprised the Fed was suggesting that their activities would be tapered. Surprised? Really? Did investors truly believe the Fed would be there forever with $85 billion of bond purchasing? We believe that the Fed is in the early stages of weaning the market from its activities, but will do so carefully so as to assure the economy can breathe on its own. Further to the uncertainty of the Fed was the suggestion from both the President and the Fed Chairman that a new Fed Chairman may be in place as soon as early next year. And one needs to ask, will that new Chairman have plans that are aligned with those currently of Mr. Bernanke? So as the Fed returns the economy to its own devices, interest rates are likely to rise, and this may pressure interest rate sensitive stocks lower and create further volatility, including some Canadian stocks. Adding to the pressure is the fact that Europe is still on unstable ground, though with politicians largely on holidays, there is little noise about this matter. China's economy continues to sputter, and the Middle East is again suffering social unrest causing oil prices to jump beyond $100 a barrel. Meanwhile, back in Canada, there are numerous indications that our economy is being challenged, including a recent slump in the loonie to below 95 cents. Given this backdrop, we continue to look for yield from both interest rates, instruments, and dividends, and to move more investments outside of Canada, particularly to the United States. We are watching for a cyclical bounce in commodities, but like the Fed, we are moving carefully, observing changes as they occur, particularly in the interest rate environment. As if we are at the inflection point in the interest rate environment after 30 years, investors need to be wary and nimble to protect themselves on a go-forward basis. That's it for this week. We thank you for listening and wish you and your family well.